LPM you're okay. The previous LPM you're not getting?
Yeah. That is.
Same issue. If you went out of the historical comparison, other people do. But the historical comparison, it's not kidding. It directly doesn't feed into anything. You might say, I'm not going to use historical growth for my company because the LPM is skewed, right? Yeah. So that's the way to think about it. Your historic numbers will mean a lot less to you than your other group ideas because you can change.
I was considering that. I was like,
Alright, so your market we go to choose. So for that I'll use my initial. And then for my actual market, leave it as cafe screen. So what is that 5-year EPS growth rate? Give me a figure. And that's fine.
Data is past
How can I see how
because what you have is regression. As long as you have 16% earnings growth of company, 8% revenue growth, what you're assuming is that the proportion is the same across
and then I use it.
the options to track
For Amazon, I did your options.
It's too little relative to the values of firm. It's too small. You got to get to about 50-60% debt ratio. Not the market value. Nobody capitalized on this. How much are you having that? They have $200 billion in That's on way side. They have $200 billion debt when the optionality kicks in. They're not.
Okay, let's get started. I thought, one of the things about acquisitions is you don't have to wait long to find a news story that kind of ties into what we've been talking about in class. Last session we talked about being on one side or another of the transaction, right? Acquiring a target. We talked about how much better it was to be part of the target than the acquiring side. So I thought this news story kind of brought that home. It's today's Wall Street Journal. In fact, it's today's story. It's happening right now. Alexion to buy Synergies for $8.4 billion. And there's a story that goes with the CEO of Alexion says it's the best deal ever. There's synergy, there's this, there's that. And all that is storytelling. But I checked out what happened today to these two companies. I'll give you the good news first. The good news is all to Synageva stockholders. The market cap yesterday for the company was roughly $4 billion. They're being offered $8.4 billion. You're dancing. This is the magic of markets, right? So you've gained $4.4 billion essentially overnight. So if you go look at the chart on the Wall Street Journal website, you see that jump, 117% today. You want to guess what happened to Alexion stock value today? Dropped. That was a good guess. That was it dropped by 10%. You think, but Synageva gained 117, Alexion dropped 10%. This looks like a net good. Here's the difference. Alexion is a $37 billion company and it lost roughly $4 billion of its value today. I don't know how this will play out eventually, but at least today it looks like a zero-sum game, right? You see what I mean by a zero-sum game? If they've paid $4 billion for nothing, that extra $4 billion premium that they've paid is for nothing, the only place I can take it out is of your stock price. And at least today, what stockholders are voting with are their feet. And basically they're saying, we think you paid too much. Only time will tell whether in fact this is true, but it'd be worth tracking this deal to see what happens over time and see if in fact the stockholders are right or the managers of Alexion are right. So interesting story. I thought it might be, So today is the last segment, valuation, and we're going to talk a lot about changing value of a company. The way I describe this class is in today's class, so up till now, we've looked at valuation from the outside and as investors looking at a company. Today we're going to go inside the company. I'm going to give you access to every lever in the company, and I'm going to ask you to change the value of the company. So I'm going to set this up, with, as always, with a few startup questions. So let's start with this first one. I'm going to give you a series of actions. And I'd like you to tell me which of these actions is a value-enhancing action. Okay? So go with your gut. A stock split. Does it enhance value? Why not, Jordan? When you say it doesn't do anything, what does it not change? It doesn't change the number of shares. Okay, so could it be a price-enhancing action? Yeah. So the first thing we're going to talk about today is the contrast between value enhancement and price enhancement. Right? Two different games. How about amortizing goodwill? Because you read these news stories. Impairing goodwill is the right word for it now. Company announces $40 billion impairment of goodwill. Good news or bad news? Value enhancing, value destroying? It could be a good thing. What does it change? Let me rephrase it. Under what circumstances could impairing goodwill actually be a good thing? There's a tax benefit. And the reason it's a good thing is because it affects your cash flows or your value. But in the US, it is not tax deductible. Yeah.
I don't know if directly or not, but it could be a value enhancing, value destroying thing just in terms of crystallizing that you overpaid for an acquisition or something like that.
That's a price. It's a price effect, right? Because basically, in fact, the way accountants impair goodwill is a pure pricing effect. They look at what's happened in that sector, and that's the biggest driver into whether you impair goodwill in the first place. It's not value changing, but it could be price changing. In fact, that's a contrast you can draw on every one of these. Changing depreciation methods in the reporting books, not in the tax books, again, it can make your reported earnings look much better. Your price could be affected by this because people are focused on earnings per share, but your value shouldn't change. Yeah.
If that's changing your management decisions, though, the way in which you're depreciating assets, could that be value enhancing?
It could be, but I'll tell you something. If managers are this caught up in changing accounting methods, the signal they're sending me about the kinds of ways it's going to change the decision is not a good one, right? Because it's saying, hey, you're focused on changing the way you report depreciation. I want you to focus on where you should expand and what businesses you should be in. So it could, but it's got to be a very, very strong link. And finally, in the late 90s, a lot of companies issued what were called tracking stock. Right? Do you know what tracking stock is? You take a segment of your business and you issue shares against that segment. So it's a .com era. It used to be the online portion of New York Times. You take New York Times online, you issue shares. By itself, in fact, those shares come with no protections. You bought a share in a business, but you actually had no board of directors, no managers looking after your interests. All you've done is taken an existing business. Nothing changes about your overall cash flows. Your price could jump though, right? Because in a sense, people say, hey, you have a social media business, you have a .com business. Every one of these decisions is, from a value perspective, value neutral, but it could be price affecting. Okay. Yes, Joe.
If you did offer a vote with that, could that be value enhancing?
Then if you have a spin-off, because basically what you're talking about is separating a business, could a spin-off increase the value? We'll come back and talk about it. There are scenarios where a spin-off could affect value. But it has to, I'm sorry?
For both companies?
The spin-off actually can increase value for both companies, yes. If it create, and it goes back to the good definition of the word focus. If you have these multi-business companies and you're running them in a way in which segments of the business are being affected because it's part of a bigger company, separating that company could increase, but it's got to show up in the cash flows or in the risk or in the growth rates or something substantial. And that's the lesson we're going to reinforce today, is the difference between value enhancement and price enhancement. And how when most CEOs talk about enhancing value, they're really talking about enhancing price. That's got nothing to do with value enhancement. Okay? Now let me follow up on that. Let's suppose you are the CEO, you've just become the CEO of a multi-business company. These are your 4 businesses. There are the returns on capital I've computed for your 4 businesses versus the cost of capital. This is day 1 as a CEO. You're thinking about selling off one of these businesses. Which one of these businesses, if divested, is most likely to enhance the value of your company, and what will it depend on? I was thinking of putting this on your final exam, but might as well ask you now. Which is your worst business? D, right? So this seems like a slam dunk, selling. But you know it's not the right answer. Why not? What is your value effect from divesting a business? It's like a net present value project in reverse, right? When you divest, you get cash coming in. What do you give up? You give up the cash flows you'd have got by continuing in this business. You see why selling off your worst business might not be value enhancing? Does everybody know that this is a really bad business, including the people buying the business? Yes. So you try to sell off your worst business. It's not like people are going to give you back the capital you invested in the business and make you whole again. Guess what? They're going to pay you what they think this business can make. And here's one of the great ironies of divestiture. You know which businesses you're most likely, so basically your value change will be the difference between what somebody's willing to pay you for a business and what it's worth to you, right? And the irony is, that's more likely to be a star in your best business rather than your worst business, because people are more likely to be dazzled by your best business and pay you too much than they are for your worst business. It kind of cuts again. Corporate finance, you're taught, shut down your bad businesses, sell them off, but it depends on what price you sell them off at. So if you take your best business and you can sell it at a much higher price than it's worth to you as a continuing business, you actually gain more than taking your worst business and selling it for less than it's worth to somebody who's willing to buy that business from you. So today we're going to talk about divestitures and how It's not just listing out best to worst and getting rid of your worst business, and looking at what somebody will pay you for a business. Let's talk about capital structure. Let's say XYZ company has 200 million in debt, 800 million in equity. Its optimal debt ratio is 20%. Yes, sir.
Sorry, what if the reason your return on capital for business C is so low is because your company can't really utilize the assets from that business, but another company would be able to get a much higher return on capital for that?
That's price versus value, right? The first is, if that company that's buying the assets from you, why should they offer you what they're going to gain out of the assets, right? If they are, then of course you should sell it. But the bottom line is, it's not that it's a worse business that's leading you to then sell it. It's the fact that somebody sees higher value and is willing to pay you that higher value. It's still a price versus value judgment that drives it, rather than...
This is the value that you attribute to it relative to the value
Exactly.
they attribute to it.
And what they're willing to pay, right? So they could attach a much higher value, but unless they're willing to pay you that higher value, you're not going to claim it, right? So the question becomes, and in many companies, multi-business companies, when a new CEO comes in, guess what happens? They sell off all their worst performing businesses at any price they can. Okay? In fact, today we're going to talk about acquisitions. The one window of opportunity in acquisitions is when you buy subsidiaries of multi-business companies that those companies want to get rid of at any cost. You can get them at a bargain and build up a company that could actually be worth a great deal. Okay? So your debt ratio, your optimal debt ratio is 20%. You are at 20%. So your CFO says, or CEO says, look, you can't lower the cost of capital. You're already at the optimal. Is that true? Are there financing choices you can make that go beyond just getting the right mix of debt and equity? Could you have the wrong kind of debt for your company? What's the wrong kind? What's the right debt for a company?
Depends on all the different characteristics of how the company generates cash flow, like whether it's cyclical or not.
Or
Structuring debt properly.
basically you tell me what assets you have, the debt should match up to the assets, right? It's corporate finance 101. You can be at the right debt ratio, but if you've mismatched your debt to your assets, you're still paying too high a cost of debt and you still have too high a cost of capital. I mean, too often in capital structure we get caught up in the debt mix question and we forget about the fact that it's not the only dimension on which cost of capital is measured. So one of the things I'd like to talk about today is what can you do in a company beyond just adjusting the debt mix to lower its cost of debt and give it a lower cost of capital. One of the things you might be able to do is match up the debt to its assets. So it's not just the right debt ratio that matters, it's having the right kind of debt. Last question, and I've talked about this often enough that you should know. Right? Let's say Google has a $60 billion cash balance, decides to return $45 billion of that cash to its stockholders in the form of buybacks. You're an investor in Google. Will that buyback make you worse off, better off, and not change your perspective on Google? And what does it depend on? Put differently, when does a cash buyback change the value of a company? First, what does a cash buyback do to your debt ratio? Assuming you have debt, a cash buyback increases your debt ratio, right, by reducing your equity. Can that affect your value as a company? Indirectly, through your cost of capital, it can have an effect on value. So one way a stock buyback can affect your value is by changing your debt and equity mix. Yeah.
Would it have an effect if the company's going from public to private?
Not if it's public or to private, but if I'll give you the other scenario where a cash buyback is good news. Remember when we talked about cash in the hands of some companies being discounted? You don't trust the company, so you put this stupidity discount on cash. A company like that buys back stock. You get almost an instantaneous jump in the value attached to the company because you're no longer afraid that the company will do stupid things with the cash. Are either going to work with Google? I don't think so. It doesn't have any debt, so basically buying back stock is not going to change the debt ratio. The debt ratio is close to zero anyway. And the second problem is I don't think Google's being punished in terms of having cash discounted in its hands yet. It might come one day. They do too many more Google glasses. Who knows what we'll start doing to them. But at least at the moment, I don't think anybody is saying, oh, no, I'm going to knock off 20% of the cash balance in Google because it's going to be wasted. So today we're going to actually bring all of those questions to play. So let's go back to the last segment of acquisitions, because I want to finish that segment before I start on value enhancement. So as I said, we talked about if you're going to build an acquisition-driven company, how you can improve your odds. And we talked about a number of choices. And I left you with those choices. You gave me your choices. Let me back up those choices. The first choice I offered you is if you were doing an acquisition, would you rather be a sole bidder or be in a bidding war? And the answer is pretty obvious. You'd rather be the only bidder, right? Let's see how bad it is to get into a bidding war. So you guys, you're the two companies, you're bidding for this. So you're two acquirers bidding for a target company. One of you wins and the other loses. Depends on your definition of winning. Let's call winning actually winning the bidding war. So you guys win the bidding war. You guys lose the bidding war. So the day after the event, you see a Wall Street Journal news story. XYZ company wins bidding war. This is actually a study that looks at what happens to those winners and losers in the 2 years after the bidding war ends. So remember, right after the bidding war, you are celebrating, right? You won the bidding war. One of these lines is your stock returns in the 2 years after you win the bidding war. Guess which one is yours? That's you. There's the loser on the bidding war. So in other words, the company that lost the bidding war is the one that sees its stock price go up. The company that won the bidding war is the one that sees its stock price go down. So if you've invested in a company that's caught up in a bidding war, what you're hoping and praying is that they lose. You're much better off if they lose than if they win, because you can see the consequences. And this is actually something we've known about in economics. It's called the winner's curse in an auction. You know what the winner's curse in an auction is? You go into an auction, let's say there's an item that you really, really, really want. So you start the bidding. You keep the bidding going, and ultimately you win the bidding war. You start celebrating. And then everybody around you starts celebrating too, for different reasons. You're celebrating because you won the bidding war. You have that Mickey Mantle rookie card, or that A-Rod rookie card, or whatever you were bidding for. You know why everybody else is celebrating? They all think you paid too much. Think about it. The next time you win an auction, think about why you won the auction. Everybody else in the room thought you were paying too much. It should sober you up very quickly. I don't know how many glasses of champagne you had before you started bidding. That should sober you up. Everybody else thinks you paid too much. There's the backing for it. Second, this is from a study that looks across acquisitions and classifies them based on the size of the acquisition and based on whether the acquisition was paid for with cash or with stock. Let's start with the easy categorization first. Those are my smallest acquisitions. Those are my largest acquisitions. Across the board, the smallest acquisitions tend to do much better than my largest acquisition. So it's better to buy small than to buy big. Mergers of equals have a really tough time succeeding. Cash versus stock is tricky. For the smallest deals, the stock-based acquisitions actually do better than the cash-based acquisitions. But for the larger deals, the cash-based acquisitions do better than the stock-based acquisitions. So when you have these really big acquisitions and you try to pay with shares, even if you think the shares are overpriced, here's what happens. People see you're trying to pay with shares, they read into it the signal that you think your shares are overpriced, and they push up the premium. The net effect is you're more likely to lose. So better small than large. Cash or stock depends on whether you're doing a small acquisition or a large acquisition. With small acquisitions, if you think your stock is overpriced, go ahead and use it. But larger acquisitions, you're better off using cash. Then we looked at different kinds of target firms. And here again, the answer is pretty intuitive. If you're going to focus on acquisitions, it's better to buy private companies rather than public companies because you don't have that market price plus phenomenon. But actually, it's even better to focus on subsidiaries of public companies that public companies want to get rid of very quickly. I do Tata Motors in my applied corporate finance class. And Tata Motors' best investment over the last decade was an acquisition they made in 2009 of Jaguar Land Rover. And they bought Jaguar Land Rover from Ford, and Ford essentially was so desperate to get rid of Jaguar Land Rover because it was creating so many headaches for them that they said, we will sell it at any price. That's exactly the kind of seller you want. A seller who is so desperate to get rid of something, they just abandon it. And wait for a new CEO to come in. As I said, that's when you see this abandonment option kind of kick in. Is I want to get rid of it, step in and buy the subsidiary. Your odds have improved significantly relative to buying a public company in that same space. And finally, if you're looking at different kinds of synergies, here are two studies from McKinsey that should kind of again sober you up. Basically, the first study looks at expected revenue, growth synergies. The second study looks at cost synergies. And what these studies look at is what percentage of the promised numbers get delivered for each type of synergy. If you look at growth synergies, only 17 out of the 77 companies actually delivered growth synergies that were more than expected. The remaining 60 delivered growth synergies that were far less than expected. With cost synergies, out of the 92, 36 delivered more than 100%, 25 delivered close to 100%. A much higher percentage of companies that promise cost synergies are likely to deliver them. So you look at two mergers, you're more likely to see value added from a cost synergy merger than a growth merger. The Alexion-Synageva whatever merger that you saw, that I showed you, is that a growth synergy merger or cost? What do you think it is? It looks like a growth synergy merger. That's the target company is too small. It really doesn't have enough of a cost structure for you to cut costs. So the odds are all. So you're buying a large public company. You're doing it based on growth synergies. I don't know what. I didn't read the rest of the article to see whether they were paying with cash or stock. It's almost like a perfect storm waiting to happen here, right? Because if they're paying with stock, that'll add to the skepticism as to whether this deal will succeed. So the next big acquisition story, read the story about who the acquirer is, who the target is, look at the relative sizes, make your judgment based on history. It's not always going to be perfect, but it's a good way to start thinking about what kinds of acquisitive companies will succeed. Yesterday, I think Bill Ackman, one of the companies, all the hedge fund guys have their conference right now in New York where they present their favorite targets. And Bill Ackman, one of his targets is actually what he called a platform company. Essentially a platform company is a company, the platform that goes out and acquires, and his favorite one of his favorite company grows through acquisitions. But if you read his description of why he thinks it will succeed, what it does, it acquires not companies but products that it puts into a platform and uses the platform to kind of leverage up the value. So in a sense, you can see why, I'm not saying that his pick is going to be right, but it's a pick that's less likely to be saddled with the kind of difficulties of growing through acquisitions that you see with public company acquisitions where you pay market price plus. So any questions on acquisitions? So if you're thinking about synergy, your odds of success are far more likely with cost synergies than growth synergies. They're much more likely if they're concrete on paper, you've planned for them, than if you don't plan for them. It's stating the obvious. They're much more likely if you hold somebody accountable for delivering the synergies and you hold that person accountable before the merger. In fact, pick the guy who's most strongly for the merger and say, okay, you feel that's such a good idea. You're in charge of delivering the synergies you have on paper. It's amazing how quickly people's synergy numbers will start to come down if they actually have to deliver those numbers. Let's hold people accountable. If you want to promise me something, let's hold you accountable for delivering those numbers. And you're much more likely to get a bigger chunk of that synergy gain if you're a single bidder rather than one of many bidders for that same synergy. So final lesson on acquisitions. If you are going to build a company built around acquisitions, you have to have the discipline to stay focused. So the way you create value is by picking small businesses that are private businesses and you roll them up to create value. Stay doing that. The problem is, as you get bigger, you're going to find that it gets more and more difficult to create the kind of growth you did when you were smaller with the same strategy. You'll be tempted to reach, which is what Cisco did in the late 90s. It was getting so big, it couldn't grow the way it did in the early 90s. it started reaching. It started making bigger acquisitions because that's the only way it could impact its growth. That's when you start to get into trouble. So I'm not saying it's impossible to grow through acquisitions. I'm just saying if you're a company and you say you're going to grow through acquisitions, I'm much more skeptical right off the top until you start telling me how you're different in the way you're going to grow through acquisitions. Any questions? And finally, remember, all these banks, there's an ecosystem around the acquisition process. In that ecosystem, everybody makes money. You have consultants, you have strategists, you have bankers. That's fine. They have their own incentives. You still have the obligation to ask the question, is this acquisition good for my stockholders? You can't blame the banker for paying too much. That'll be like me blaming the electronics salesman for selling me the wrong type of TV for my house. That's not his obligation, that's mine. I have to make sure that my interests are protected. CEOs of acquiring companies have to make sure the same thing happens. Okay? So let's talk about value enhancement. As I said, it's the last piece of this puzzle. Let's bring it in. The way I describe this particular part of the presentation is where corporate finance meets valuation. Those of you who remember your corporate finance, you're going to see a lot of familiar aspects of what you did in your corporate finance class here. For those of you who don't remember corporate finance, you'll be seeing a lot of things that should be familiar, but will get familiar hopefully by the end of the session. To begin though, let me draw a contrast between value enhancement and price enhancement. I'm going to use two charts to bring home this point. The first is actually from a study that was done in the late 90s. The title of the study was A Rose by Any Other Name was the title of the study. And what it did was it looked at, I think, 60 plus companies that changed their names. You say, what's the big deal? Companies change their names every day. These companies were picked because they added .com to their names. Remember, these were the late 90s, and changed nothing about the way they do business. So all that's different about the company today as opposed to yesterday. Yesterday you were XYZ company, today you're XYZ.com company. That's what happened to their stock prices the day they announced the .com at the end of the names. The stock prices jumped by 100, 120. Many of these were tiny companies. You add .com, the stock price jumps 150%. You think, this is great. We've wasted 24 sessions on cash flows, growth, and risk when we should be talking about company names, right? But here's the catch. See the second graph? That is actually from another study that was done about 5 years later that looked at companies that changed their names. You know what they did? They took .com out of their names. Because this was 2002, 2003, and by now you're looking at .com being a bad thing. These companies take .com out of their names, the stock price jumps again. That's the problem with price enhancement. How do you enhance prices? You keep the market happy. What do you have to do to keep the market happy? God only knows. What makes it happy today will make it unhappy tomorrow. CEOs who try to keep the market happy are almost destined to fail because you're dancing a tune that essentially has you have no idea what's coming next. When you say keeping the market happy, I would replace market with analysts. I've heard CEOs say, my job is to keep equity research analysts happy. No, that's not your job. Your job is to keep investors happy and analysts will follow. If you focus on analysts as your front and center and that's all you're going to pay attention to, then bad things are going to happen. So I'm going to focus on value enhancement, and when I focus on value enhancement, things actually get a lot simpler. Because to change the value of a company, I've got to change one of the numbers that go into my valuation, right? So if, at the risk of sounding simplistic, to change the value of a company, here are the 4 things I can change. I can try to increase my cash flows from existing assets, right? That's the first step. How do I do that? Maybe by cutting costs, by being more efficient, maybe paying less in taxes. So step 1 is, can I increase cash flows from existing assets? Step 2, maybe I can add more value from growth. By doing what? By either reinvesting more, doing acquisitions, taking more projects, or by reinvesting better. So increase value from expected growth. So I can increase cash flows, increase value from expected growth. Third, maybe I can lengthen my growth period. Sounds like just on a spreadsheet, it's so easy, right? Just change 5 to 10. But for a real company, what does that mean? Basically, this is where your competitive advantages, barriers to entry come into play. Maybe by coming up with new barriers to entry, you can lengthen your growth period. Or finally, maybe you can reduce your cost of capital by either changing the mix of debt and equity or changing the type of debt you have. or even changing the product characteristics you have, because that feeds into your cost of equity and capital. Everything you see in a restructuring is somewhere in those 4 numbers. So what I'm going to do is actually take each of those 4 numbers and go through the process of what can I change in a company to change those numbers. So let's start with the cash flows from existing assets. EBIT times 1 minus T minus net capex minus change in working capital is free cash flow to the firm, right? That's the way we started the cash flow discussion. So for you to increase the cash flow, one of those numbers has to change. So let's start at the top. When I think about EBIT, I think of it as a product of revenues times operating margin. So maybe if you can cut costs and be more efficient, what I hear is higher margins on the same revenues, I get higher operating income. So cost cutting, more efficient operations. Assuming you mean what you say, because a lot of companies talk about cost cutting and more efficient operations, but they really don't mean what they say. So that's step 1. If you have businesses that are losing money, that you expect to continue to lose money forever, shut them down. Sounds obvious, right? Well, so why wouldn't somebody have done it already? Because people hate to admit mistakes. I call this the sunk cost problem, which is once you've made a mistake, it's very difficult for you to walk away from that mistake if you made the mistake. There's a reason A-Rod is still at third base. You know what the reason is? Brian Cashman still runs the Yankees. So what's the connection? Well, Brian Cashman signed A-Rod. The minute he says, I made a mistake, people can latch onto it. As long as he doesn't deal with it, it doesn't look like a mistake. Everybody knows he's made the mistake, but admitting to it is difficult. So if you have money-losing businesses that you expect to lose money forever, shut them down. Give them away. Because if it's all losses forever, why even keep them on? The third thing I'm going to suggest is going to sound mildly unpatriotic, but take it for what it's worth. I've never viewed it as the objective of any company to maximize taxes paid to the government. Maybe you do. So within the framework of the law, so I've protected myself fully, you should try to minimize the taxes you pay to the government. How can you do that? Well, if you can move income to lower tax locales within the framework of the law, you should do this. My son is actually graduating from college in a couple of weeks, and one of the jobs he looked at was transfer pricing. And I said, please don't do this. Please, I beg you, don't do this. What's transfer pricing all about? What is transfer pricing first?
Internal pricing.
It's internal pricing when you have a multi-geography company, right? What's the big deal? You know what the biggest factor in transfer pricing is? Taxes. That's all it is. This whole game is a tax game. You can dress this up as much as you want. You can say, I want economic prices. Let's stop the baloney. Transfer pricing is about using the legal framework to move income from high tax locales to low tax locales, so you pay less in taxes. And if you do, I'm not going to view you as unethical or immoral. That's basically what companies should be doing within the framework of the law. If you're a multi-business company also, if you can shift from a higher tax to a lower tax locale, that's what the inversion stories were about. Again, within the framework of the law, if you can do it, of course you should do it. There's nothing more immoral or unethical about it. You are a legal entity. Your obligation is to minimize taxes paid. And I'm not a great fan of risk management in general. I think companies overmanage risk. But one of the benefits you might get from risk management is if you smooth out earnings over time, you might actually pay less in taxes, especially if you have spikes in the tax rate by avoiding them. But all of that shows up as a lower tax rate, and through a lower tax rate it shows up as higher operating income, higher cash flows, higher value. If you've overinvested in the past, you're at 300% capacity, stop. There's no law that says you have to keep building a factory every year. Live off the fat for a while. The fat, of course, is depreciation will continue to come in. So if you're over capacity, it shows up as no capex or low capex for a period before it kicks in, higher cash flows. And finally, if you're a company with significant working capital requirements, managing working capital better can do wonders for your cash flows. Just ask Walmart. Because until Walmart came along, you know what the rule was with retail companies? In fact, when I took accounting, the rule was the current ratio should be 2. That's what healthy companies have. What does that mean? Your current assets should be double your current liabilities. Walmart came along and said, that's stupid. Because if I do that, I have this big working capital requirement. It drains my cash flows. What if I made it neutral? In other words, my current assets are equal to my current liabilities. Can reduce it. In this case, can make a in the case of Walmart, at least, that adds about $1.5 billion to its cash flows every year, managing working capital more efficiently. Everything designed to improve cash flows from existing assets. So your first stop when you come into a company is you're looking at the existing assets saying, can I manage these assets more efficiently, generate more cash flows from them? If I can do that, holding all else constant, my value increases as a company. So that's stop one. Second stop in this process, think about growth. Increasing growth by itself doesn't increase value. By now in this class I've said that 100 times. For growth to increase value, that growth has to be accompanied by excess returns. You've got to earn more than the cost of capital. So if you go into a company, the first stop you make is you look at the reinvestment rate, look at the return on capital, and you ask, can I change one or both of these numbers? If your return on capital is above the cost of capital, you're earning more than your cost of capital, reinvesting more at that return on capital will increase your value. How can you reinvest more? Well, you can take more projects. If you can pull it off and you can do acquisitions and earn that high return on capital, all the more power to you. So reinvest more as long as you earn more than the cost of capital. Alternatively, you could increase the return on capital and not reinvest more, and your growth went up and your value went up. In fact, I like to think of the return on capital as a product of your operating margin and what's called the turnover ratio. And the reason I like that is you think about retailers. Often you talk about same store sales and margins. If you want a high return on capital, you either have to pump up your same store sales so you don't have to open new stores to get those sales, or increase your margins. Both pathways to get to a higher value. In my start of my corporate finance class, I kind of half jokingly say everything you do in your MBA program is in service of my class. I'm going to say that again. Everything you've done in the MBA program is in service of this class. This is your marketing class, right? Everything is in there. Talk about price leaders and volume leaders and all that stuff. I don't even remember enough marketing. But everything you talk about in marketing is somewhere in there. I can show that in the margins, in the capital turnover ratio, in the return on capital, and in the value that I get out of that strategy. Incidentally, with growth, this is one of the more interesting studies I found. It's from McKinsey study from a few years ago, where they compared different ways of growing. Because they have this 40-year proprietary database of every client, McKinsey client, and they've kept track of how these clients have tried to grow, and they've kept track of how much success they've had. So I'm going to rank from best to worst what McKinsey found as successful growth strategies and unsuccessful ones. Across time, the most successful growth strategy, according to McKinsey, looking at its clients, is to come up with new products. Of course, classic examples of this are the Apples of the world, right? The iPod, the iPhone, the iPad. You got every $1 billion invested in developing new products adds about $1.75 to $2 billion in value on average. But here's the catch. It's a very skewed strategy. If it works, you make tons of money. If it doesn't, of course. So you can think of Microsoft as the example of somebody who tries to produce new products and has nothing to show for it. But if you were starting from scratch and you can develop new products, by far the most successful growth strategy historically. Second best strategy historically, expanding an existing market, either geographically or finding new uses for it. So if you're an aspirin maker, the fact that aspirin is now treated as a heart medication and a heart disease medication actually increases the potential market. Or if you're a US-based company, finding emerging markets where you can sell your product is a geographic expansion. $1 million invested in that strategy creates about $0.3 to $0.75 million in additional value. Now we're getting to the middle of the strategy. Maintaining a growing share in a growing market. So this would be the good example for this would be Samsung and Apple over the last 3 years. They're fighting for the smartphone market, but the smartphone market itself was growing about 10% a year. The fact that your market share is not going up, in fact Apple's market share has decreased, is not hurt them because the overall market has grown enough to cover up their weakness. $1 million invested there creates between 0.10 and $0.5 million in value. And then you get to the bottom of the barrel. And there are two strategies historically that have not worked very well. And you can see why. The first is to compete for share in a stable market. $1 million invested in that strategy creates anywhere from minus 0.25 million to plus 0.4. So this is a strategy that about a third of the time delivers negative value. Why is it so difficult to create value competing for share in a stable market? Sorry, period?
Are you really doing this pricing?
The only way you can compete for share in a stable market is to cut prices, right? So you get the higher market share, your margins get squeezed, and you might have growth and you might have a higher market share, but at what cost? And at the bottom, of course, is acquisitions. You know how I use this? You'd read these strategies. Companies say, we're going to grow, and then they tell you how they're going to grow. Sometimes all you have to do is read how they are going to grow, and you can already pass judgments on, is this the kind of company I want to put my bets on or not? So Microsoft's announcement, or it's quasi, I don't even know whether it's official, rumored acquisition of who? Salesforce.com is leading me to reassess whether I should continue to hold Microsoft. Again, I'm not saying it's a bad deal. I don't even know what the deal is going to look like, but think about it. It's going to be a $45 to $50 billion deal, and that's, I don't even know what the premium they're going to have to pay. It might end up at 55 or 60 billion. That's a big acquisition of a public company with a premium paid over the market price. God only knows what you'll end up with. So growth, not all growth strategies are created alike. They might all look alike when I list them out, but if you look at the history, you can see that the odds are better for some strategies than others. So increase cash flows, go for higher value from growth. Third stop, maybe I can grow for a longer period, which, as I said, is another way of saying maybe I can either augment an existing competitive advantage or find a new one. Now, I'm not in corporate strategy, and you know that already, but looking at this from the outside, I can see 4 potential competitive advantages that you might be able to have or have already. The first, of course, is brand name. Remember, we valued the brand name for Coca-Cola? And the way I define the value of a brand name is you get to charge a higher price for exactly the same product. So if you have a brand name, nurture it. If you don't have a brand name and you can create it, go for it. Tremendously significant competitive advantage, lasts a really long time. You can make yourself a much more valuable company. That's not suggesting it's going to be easy to do, but to the extent that you can get there by trying, no harm in trying. The second is legal protection, which is, wouldn't it be nice if the government stopped in and protected you from competition? Effectively, there is one business where it happens all the time, right, which is the pharmaceutical business. Patents offer you that protection. But be very careful what you wish for. Sometimes the government will step in and protect you from competition, but in return take away something even more valuable. Let me back up and explain. 30 years ago, if you were a phone company, you were protected from competition, right? You're a regulated monopoly. What the heck does that mean? First, if you're a monopoly, everybody hates you, right? Now, normally, if you're a monopoly and everybody hates you, there's an easy way for you to get back at them. You know what you do? You charge them a higher price. You hate me? 30% more to you. Makes you feel a lot better as a monopoly. You're hated, but you're profitable. But if you're a regulated monopoly, here's what happens. Everybody hates you because you're a monopoly. You get ready to charge me 30% more because I hate you. But if you're regulated, now I have to go in front of a regulatory commission composed of politicians who say, you know what, this year we'll give you 2%. This is the worst of all worlds. I'd rather have no protection from competition, have pricing power, than have protection from competition and no pricing power. But to the degree that I can get protection from competition, I'm going to go for it. And as the pharmaceutical companies then recognize, if you can increase that protection from competition, it effectively increases your value as a company. You can hire better lawyers. Maybe your 17 years can become 21 years of protection. That's a substantial increase in value. That's what we were trying to capture with that optionality. Third, switching costs. You know what switching costs are? You want to make the cost of switching into your product as low as possible. And once people switch in, you want to make the cost of switching out as high as possible. Every time you walk by one of those cell phone companies, You can see the staring at you, right? Just come on in, we'll switch you right now. So you're AT&T, you walk by the Verizon, so oh, just come on in, you can do it in 5 minutes. You do it, and right after that they give you this long document. Runs about 15 pages in really tiny print that nobody can read. So please sign this. You sign this, you've just signed away your life for the next 2 years, right? Who can blame them though? Without that, what would you have? You'd have people switching every day. AT&T today, Verizon tomorrow, you know, T-Mobile maybe not. No. But basically every day you'll keep switching because it's just a commodity. So this is the competitive advantage they have to create. So I can see why they do what they do, even though I don't like it, because that's the only way they can differentiate themselves. And finally, if you have cost advantages as a company, you know what I mean by cost advantage? It costs you less to produce a product or service than your competition. Take advantage of it in one of two ways. You can either charge a lower price than everybody else and end up with a bigger market share, or you can charge the same price as everybody else and end up with much higher margins. Effectively all ways which feed into your value. So when you walk into a company, look around and say, I can't find any competitive advantages in this company, you know you're in trouble. Your job as a CEO then becomes coming up with a competitive advantage for that company that actually sticks. Not easy to do, but if you can do it, you've lengthened your growth period, increased the value of growth, and increased your value as a company. Which brings me to my final way of increasing value. Maybe I can reduce my cost of capital. If you take any corporate finance class, of course, it's centered around finding the right mix of debt and equity for your company. So if you take in my corporate finance class, we talk about the optimal debt ratio. You go from 0 to 40%, your value increases, and that's perfectly good. That's a good way to think about how to reduce your cost of capital, but it's not the only way. Here are 3 other things you might be able to do that reduce your cost of capital. The first is maybe you can make your product or service less discretionary. Remember we talked about betas? We said your beta as a company will depend on how discretionary your product or service is. The more discretionary your product or service, the higher your beta. If you can make your product or service less discretionary, either by changing its characteristics, okay, or through advertising, you've effectively lowered your beta, lowered your cost of equity, lowered your cost of capital. I mean, 20 years ago or 10 years ago, I asked how many of you have cell phones. Maybe a third of the class would have said yes. And I said, can you live without your cell phones? You said, I guess so. Today, if I ask how many of you can live without your cell phones, in fact, the only threat that used to work on my daughter when she was in high school is you could threaten her with everything. We'll send you to Siberia, I don't care. Yeah. He said, I'll take away your cell phone. Okay, what do you want me to do? Made it non-discretionary enough that at this point he's saying, do I need food? I can live without food, but I can't live without my cell phone. That effectively lowers your beta as a company. So if you can make your product or service less discretionary, do it. If you have lots of fixed costs, reducing fixed costs effectively lowers your beta, lowers your cost of equity, lowers your cost of capital. And finally, if you've mismatched your debt, you have short-term debt funding long-term assets, dollar debt funding euro assets, get rid of that mismatch. And there are lots of ways you can do it now, right? You can do swaps, you can do derivatives, things you didn't have access to 10 years ago, 20 years ago, you can do now. All of these things are designed to lower your cost of capital. So here are the 4 things you can do. You can try to increase cash flows from existing assets. You can try to increase the value from growth. You can try to build up competitive advantages and keep growth going for a longer period. You can reduce your cost of capital. You're ready to be a CEO of a turnaround company. You walk into the company. Which of these 4 are you going to use? Pick any troubled company that you can think of. So what would I use? Obviously, the answer is going to depend on the company, right? If it's an old-time manufacturing company, your biggest plays might be improving cash flows from existing assets, running the business more efficiently. If it's a software company, your biggest play might be increasing the value from growth. For some companies, it might be changing the financing mix and trying to get more tax benefits. The solution has to vary across companies, which is part of the reason that if you have a turnaround CEO, you've got to be very careful about making sure that the skill set that made him or her a successful turnaround CEO in one company is the skill set that you need for your company. Because if you bring in that CEO into a company that requires different skills, you can destroy a company. And I remember Al Dunlap made his reputation at Scott Paper by cutting costs. It's called Chainsaw Dunlap. Then he was brought into Sunbeam, a company which did not have a cost problem but had a strategy problem. And Al Dunlap does not have a strategic bone in his body. And guess what he did when he came into Sunbeam? He cut costs because that's the only thing he knew how to do. The solution has to fit the problem, and in this case that's got to vary across companies. So what I'm going to do is actually take you through a couple of companies and let you be the CEO of these companies and tell me what you would change about the way these companies are run. So here's my first valuation. It's a German software company, SAP. It's still around. It's probably Europe's largest software company. And this is a valuation I did in May of 2005. I won't bore you with the specifics of the valuation, but I want you to look at the numbers and think about if you ran this company tomorrow being May 6th of 2005, what would you do differently? So this is a company that reinvests about 57.4% of its after-tax operating income, has earned a pretty good return on capital on that investment, about 20%. Its cost of capital is 8.68%. It's almost entirely equity funded. Why? Because it's a very conservatively run German company. And the value that I got for the company based on those characteristics was about 106 euros per share. So it's growing a lot by reinvesting pretty well. It's funding that reinvestment almost entirely with equity, and I bring you in to run this company. So let's go item by item. Do you think there's potential for cost cutting here? How do you decide that? You can look at your company, you can look at the sector, you can look at margins, EBITDA margins, EBIT margins, and see if in fact this is a company with a lot of inefficiencies. The case of SAP, you would have found that a company which actually has higher margins than the rest of the sector is doing much better, so that's going to be tough to do. You say, well, maybe I can go for higher growth. Well, you can't exactly push up the return on capital if it's already up at 20%, which is a pretty high return on capital. It is true you could try to reinvest more. And I'll give you one thing that SAP does that you might be able to fix. In 2005, SAP was almost entirely in Europe and the US. It refused to go into emerging markets for the same reason that it doesn't borrow money. Its managers were very conservative. So that's one open door, right? Maybe you might be able to reinvest more in emerging markets. Of course, that will bring with it more risk that you got to build into your cost of capital. You know the other thing you might want to fix? It's 99% equity, 1% debt. We know that increasing debt doesn't always help you, but there is, the company makes a lot of money. It should be able to borrow a little more than 1%. But there isn't that much room to run. It's a pretty well-run company. So if you think about levers, there's very little give in some of these levers. It's not like I can increase my operating income, I can reduce taxes, I can do this. There's not much you can do. But one of the things I looked at was that cost of capital, because I looked at it and said 1% debt, that sounds way too low. How much can they borrow? To answer that question, I took SAP through different debt ratios. And if you think about it, when you change the debt ratio, you got to factor in what it will do to your cost of equity and the cost of debt. The overall effect is, if you look at the numbers, they can afford to be at a 30% debt ratio. The way I say that is, at each debt ratio, you lever the betas, you change the ratings. The cost of capital actually goes from 8.72 down to 7.95%. They're at 1% debt, they could potentially be at 30% debt. Okay? That's one change I made. So I changed the debt ratio to 30%, changed the beta, changed the cost of equity, changed the cost of capital. So if you compare the cost of capital, 8.68, they have lowered the cost of capital 8.24%. I have to be completely honest. That decrease in the cost of capital is coming from where? From the way the tax laws are written that benefit debt. It's really the tax. I'm really taking from the taxpayers. Do I feel soiled by doing that? No, it's the way the tax law is written. It's not my fault. I can't rewrite the tax law. I'm taking advantage of the fact that interest is tax deductible. So lower cost of capital. I did increase my reinvestment rate to 70%, but I did direct that reinvestment almost entirely into emerging markets, and I adjusted my risk premium to reflect the fact that I will now have more risk in my cash flows and my value. So what I'm trying to do is be realistic. I can't just pump up the reinvestment rate in emerging markets and leave the equity risk premium where it is. The end result of this is, if I can make those changes, my value per share goes to 127 euros. If you don't remember, it was 106 euros per share. The value with my changes put in is 127 euros. Not a huge jump, but I shouldn't expect a huge jump. This is a well-managed, well-run company, albeit a little conservatively run. So I'm making it a little less conservative, but I'm not making huge shifts in the way the company is run. Yeah.
SAP isn't necessarily like a company the way that the Google is, but I mean,
This is more like Oracle. SAP is actually closer to Oracle in what it does, the business software company.
business software.
Right.
But could you say that oh well, I guess this is an issue of them having too much cash. Just like the reason why they're not taking on debt and why they would find
It could be that their defense is it's too uncertain, which is fine. So maybe they'll come back and say 30% is too much, 20% will stop at 15%. But essentially that's, I mean, there's lots of things we don't know. Maybe there's a reason they can't be in emerging markets. Maybe their software is not compatible with emerging market businesses. So it's entirely possible when you look at a company from the outside that you see possibilities, that you go into the company, you find that those possibilities cease to exist. That's one of the problems activist investors sometimes face when they target companies. They think all kinds of things are possible until they get into the company and find out that they're not that possible. Right? So this is a well-run company, and you can see a potential for changing value is relatively small. But went from it's about a 20% increase in value, 106 to 127. Let's take a second company. This is Blockbuster. In about 2003, 2004, about the time Carl Icahn targeted it. Blockbuster, for those of you who don't remember, yeah, go ahead.
Sorry, wouldn't you increase the reinvestment rate as much as you can? Why do we stop at 70?
Because, okay, the question is, if the only constraint were capital, you'd keep taking projects till when? So the marginal return on capital. So in fact, don't expect you don't want the average return on capital to drop to your cost of capital, but you want the marginal return on capital. But that's if your only constraint is a financial constraint. The problem in many companies is it's not just a financial constraint, there's an idea constraint, there's a people constraint. So those are the things I'm not exploring, so maybe they can get up to 90, 130, 150, but I have no way of knowing until I get into the company. No. But you're right, maybe there's even more potential for reinvestment than I am thinking about. But I kind of made only a small step because I don't know enough about the business to make a big leap.
Okay, but aren't we being then aggressive with by maintaining the same?
That's a good question. It's because if I stayed in the same market, said reinvest more in Europe and the US, I'd have lowered the return on capital.
Yeah.
And a 70% reinvestment rate with a 19% return on capital would still deliver a higher value than a 57% reinvestment rate with a 20% return on capital. It's a fact that I'm assuming that the reason they're not going into emerging markets is not because the returns are not high, but because they're afraid. Okay. Again, I could be wrong, but when you look at these changes, you want to be as realistic as you can about making those changes. I mean, in a sense, this is what the 3Gs of the world do with the old time, the Heinz, because when they come into these companies, they're essentially looking at companies that are set in their ways. What can I change about this company? And 3G in particular focuses on these US companies that have historically been too US based. And then said, okay, maybe if we can take these products to Brazil and India and we might be able to increase value. They might be unrealistic about those expectations, but those are the mechanics you're focusing on. So let me go back to look at Blockbuster. As I said, I picked this company because Carl Icahn had just targeted the company. And I did a status quo. So basically with each of these companies, I'm going to do two valuations, a status quo valuation with the existing management running the company, and an optimal valuation with quotes around the word optimal. If you look at the status quo valuation of Blockbuster, you again going to be the CEO starting tomorrow, and I present the valuation. Here's what they're doing. They're reinvesting about 26.5%, which basically means they're opening about 40 new stores every year. This is in 2004 when people have stopped going into video rental stores already. Netflix has already started to get a foothold, and Walmart is starting to rent out tapes at $1 a tape. Blockbuster is still opening stores. Their return on capital on these stores is about 4%. So not only are they opening stores, they're opening stores in spite of the fact that the returns are so awful. And the cost of capital for the company, even though it's low, is much higher than the return on capital. So this is a company that's not just in a bad business, but is growing that bad business. Unlike SAP, you have a lot more. This is going to be a company where you can come in, and what's the first thing you're going to say? What's your first edict as soon as you walk into the company? Stop opening stores. This doesn't take a genius, right? You're going to stop opening stores. That's like essentially removes that value destruction you have going on with the new stores. Sounds absurd, right? You're saying, why would somebody already have done it? I'll send you this, actually one of the most fascinating interplays I saw in the last couple of weeks was when the CEO of Fiat, Sergio, he was in Detroit talking about the auto business. It is the most honest self-appraisal of a business from a CEO that I've ever seen. Because here's what he said: this is a rotten business. And then he takes it apart. He shows that not only is the return on capital below the cost of capital, he talks about what it is about the way automobile companies operate currently that gives them that result. And he ends with a plea that automobile companies collectively have to change the way they operate because this is not working. In fact, his presentation was called Confessions of a Capital Junkie. Basically, he was looking at return on capital. The day after his presentation, you could see the responses from all the other auto companies. You know what they were all saying? No, thank you. We'd like this path we've picked. We're going to continue to do what we do. So if I get a chance, I'll send it to you. It shows you how people can get locked into bad businesses and continue to grow those bad businesses, even though everybody around them, including the CEOs of these companies, know these are bad businesses. So if you look at the value that I'm getting, $5.13, a big reason for that low value is I'm assuming that these companies will continue this pathway to insanity, grow by taking more projects that earn less than the cost of capital. You walk into the business, here's the first thing you're going to do. You're going to either make the cost of capital or you're going to stop investing. In fact, I could make the reinvestment rate 0, I'd get roughly the same value. So essentially, I'm not asking you to do miracles. I'm just saying earn your cost of capital or stop growing. If you make just that change, your value per share increases from $5.13 to $12.50 per share. That's a value of control of what, 150%. If you have a badly managed, badly run company, it's amazing how much your value can change when you shift from what the company is doing right now to a much better path. Yeah.
You're like a private equity firm where you're like looking to buy Blockbuster. What if you were like ahead of the curve and you said like, oh well, there's a streaming thing that's really interesting. Like maybe we could bump up the return on capital
To do streaming?
yeah, like
Just be careful that you're not overreaching, right? But Blockbuster is not exactly a technologically savvy company. It's not, so it's not just a question of we're already in this business, we can do it. But maybe you could be ahead of the curve and look at ways in which...
this is like well before.
So you could go, so basically you're saying I'm not just going to stop being in a bad business, I'm going to find a good business to be in, right?
Yeah.
Which would increase value even more. The question is there something in this, is there something Blockbuster specific that's going to help you in that good business? And the answer is no. Don't bring that in and pay a premium for that good business because it has nothing to do with Blockbuster. So unless it's a platform that Blockbuster has, maybe the user base, maybe they have data on you because you're a Blockbuster customer that they can use in the streaming information. It's an option. It's basically like the option to expand we talked about. There's an optionality here, but how much the option is worth depends upon the exclusivity that you see. I don't think there's enough of it in Blockbuster to pay that premium, but maybe in a different old economy company, maybe an example would be AOL. Right? Somebody's valuing AOL, and I was surprised how many people still. Do you know there are like millions of Americans who still use phone lines to get online? No, they're the old call-in lines. That's AOL. So AOL has this user base of people still calling, I don't know, they have the old-time modem where they put the phone on the modem and a little buzzing sound shows up, connected. But there are people out there. So, but that business obviously is shrinking. As this morning I was talking about Uber in my corporate finance class, and there's some people who are still unfamiliar with it. And I said, what are you, 65 and have a flip phone? I mean, that's pretty much the portion of the market that hasn't ever heard about Uber. But there is this segment of the market that AOL has. It's a shrinking business. So if I valued AOL as a standalone business based on what it does, it's a business where it's going to get smaller over time. But let's say you walked in and said, well, I have this user base. Maybe there's something else I can do with this user base. and you'd have to tell me what it is and why it gives you an advantage, then you're talking about that something else being an option and being willing to pay for that option. But you have to make sure that there is that exclusivity that drives that extra premium. Okay? But the basic point I'm trying to make is when you think about the value of control, and we kind of embarked on this with acquisitions, this is where you start. You do two valuations of your company. Status quo value, optimal value. If the two numbers are the same, walk away. There is no value of control in this company. This company is already perfectly managed and perfectly run. I'll also tell you that in 31 years of valuation, I've never valued a company that does everything perfectly well. Every company has a blind spot, right? It might be that they don't borrow money, they don't pay out dividends. But if you have a perfectly managed, perfectly run company, the status quo value and the optimal value will be the same. But almost every company, there's going to be something that keeps those different. The bigger the difference, the greater the value of control, but you're not quite done. Because to get the expected value of control, I've got to multiply that difference by the likelihood that you can actually change the management of the company. And what's going to determine that? Let's say you think Google is badly managed and badly run. Not much you can do about it, right? Why? You have two classes of shares, and Larry Page and Sergey Brin control all the voting shares. You might not like the way Facebook is run. Nothing you can do about it. So you're going to look at corporate governance and all. This to me is a true measure of corporate governance. Is can I change the management of the company if I felt the management was not running the company right? So you're going to look at takeover restrictions, you're going to look at voting rules, you're going to look at access to capital, you're essentially going to look at all the things that you need to change the management of the company. Your expected value of control is the product of that probability that you attach to changing the management and the change in value that you get if you change the management. So here are some things to look at when you think about the probability that you can change the management. First is you're going to look at corporate governance rules, and as they change, the probability of changing management of a company will change with them. You're going to look at activist investors, because you know what they do? They shift the game. The more activist investors there are in the game, the greater the chance that management at every company will feel the need to respond to stockholders. I mean, I was looking at the top 25 hedge fund managers you saw there. You took those top 25 out of the market. I'll wager every incumbent CEO will sleep a little sounder, right? And that's not good for the rest of us. So when you think about activist investors, remember, we all piggyback when they exist because they increase the chances of management change at every company. Not just to the ones that they target, but across the board. And finally, every time there's a hostile acquisition, there is a wake-up call to the rest of the management in that sector saying, hey, wake up, this could happen to you. So all those things feed into the probability of control changing. So one of the things, and this is one of the toughest things to do in a company, is estimating what that probability of change is. There are actually studies that go back about 20 years that try to estimate this by looking at companies that have actually been taken over. I don't know whether you've ever seen Probit. Probit actually, what you do is you take every company that's been acquired in the last 20 years, and you put a 1 next to those companies. And you take every company that's not been acquired in the last 20 years and you put a 0. So basically think of that as the variable that captures whether a company was taken over or not. And then you throw independent variables. Variables that you think, independent variables that you think explain why companies get taken over. Maybe it can be how well the stock has done. Is how much stock insiders hold? Or is the company well managed or badly managed? It's like a regression, but basically what you're trying to estimate is the probability of control changing in a company. So if you give me a company, I can tell you in this company the chance of management changing is very low, average, or maybe very high. So here are some of the things that people have found affect whether you can change management. The worse the stock has performed and the worse earnings are for a company, the greater the chance management will be changed. Second, companies with small boards of directors are more likely to change CEOs than companies with big boards of directors. That's actually a very interesting thing because it says corporate governance. Maybe the first thing we should be focusing on is, are there 9 people on your board or 25? A 9-person board, much greater chance of management changing. Third, ownership structure matters. Right? So if CEO changes are more common in companies where you have low insider holdings and high institutional holdings. Right? And finally, you tend to find that CEO changes happen more often in businesses, companies that are in competitive businesses than companies in kind of insulated and protected businesses. Again, I'm not suggesting that any of these is a perfect indicator, but when you look at your company, all of these things might be worth looking at to make a judgment on the probability that the management of your company can be changed. So I'm going to give you 4 places that this expected value of control plays out, because I think it affects all of us. The first and the most obvious, of course, is any time you have a hostile acquisition, you really are talking about the value of control, right? That you will change the way the companies run. So let's start with that. Second, I'm going to argue that any time you and I invest in a publicly traded firm, whether we like to or not, we're making a call on the expected value of control, because the market price reflects some of that value. What I mean by that is, if you have a badly managed company and you get a low value, you'd normally expect a low price, right? I'll tell you the exception though. If you have a badly managed company where there's a high chance of management changing, you know what might happen to the price? The price will start to drift up, because people build in the expectation the company going forward will be run by somebody else. So whether we like it or not, we're making bets on expected values of control when we invest in companies. Anytime you're voting and non-voting shares, I'm going to argue the premium between those 2 shares is a function of the expected value of control. Or put more specifically, if you have a perfectly managed, perfectly run company, voting and non-voting shares should trade at the same price. The worst managed and worst run a company is, and this is almost ironic, the bigger the difference will be between the voting shares and the non-voting shares. And finally, in private businesses, there is something called a minority discount. Do you know what that is? Buying 51% of a private business is very different from buying 49%. You think it's only a 2% difference. That 2% difference can translate into a 20% difference in value, because that 49% gives you no control, the 51% gives you control. Again, expected value of control. So let's take each of these scenarios. Let's start with the hostile acquisition play. Let's say you look at Blockbuster. Remember the 2 values I came up with? $12.47 was my optimal value, $5.13 was my status quo value. The actual stock price was $9.50. As an acquirer, that $9.50 is much higher than the $5.13 status quo value, right? But it's lower than the $12.50 you estimate as the value you would have if you ran the company. So if you did a hostile acquisition of this company, you'd be willing to pay up to $2.97 as a premium to buy the company. But if you paid the entire $2.97 though, we talked about this last time, you're going to end up with nothing as the acquirer, because the target company's stockholders are going to walk away with the bulk of it. So you'd like to start at $9.51, $9.52, $9.55, $10, but you need to know what that $12.47 is, because that's your threshold. That's when you stop the bidding and say, okay, I'm not interested anymore. So the next time you see a company targeted in a hostile acquisition, it might be worth doing 2 valuations of the company, a status quo valuation and optimal valuation, because the market price is going to end up somewhere in the middle, and you've got to ask yourself, how close to the optimal value will I end up by the time this entire process plays out? So that's a hostile acquisition. Let's go back and think about the 2 numbers, $5.13 and the $12.47 that I got for Blockbuster. The market price I said was $9.50. What if I gave you those 3 numbers? Which 3 numbers? The status quo value, the optimal value, and the market price. And I said, can you tell me the probability that the market attaches that management in this company will change? It's like an algebra problem, right? You got the $9.50, which is the price. You got $5.13, which is the status quo value. The probability of control changing times that difference is what you're going to expect the market price to be. And if I work out the numbers, it works out to be 59.5%. The market is attaching almost a 60% probability that management will change. And here's the interesting number. That was after Carl Icahn had shown up as an activist investor in Blockbuster. Before he showed up, the stock price was $8.20. And if you backed out the probability based on the $8.20, the probability was only 42%. Carl Icahn is not changing the value of the company here, but by showing up, He's increasing the probability that control will change, and by doing that we all benefit as stockholders because the price starts to drift up. In fact, I tell people, imagine a world where tomorrow we woke up and we were told you can never change the management of any company. You know what's going to happen? Stock prices are going to collapse. You know why they're going to collapse? Because if you have two values for every company, a status quo value and an optimal value, by removing the chance of changing management, what have I effectively said? Forget about the optimal value, it doesn't matter. Every company will get priced at the status quo value. Conversely, if I have a market where nobody's ever been displaced before, managers have never been replaced before, a market with horrible corporate governance, and I introduce good corporate governance into that market, even if nothing changes about the companies, you're going to see stock prices increase, right? And you're going to see them increase most for those companies that are worse managed in that market, not the best managed companies. So start making a listing of the emerging markets with the worst corporate governance. It's a very perverse investment strategy, but hang in there. Then take the worst companies in those worst markets and put all your money in them. Then hope and pray that corporate governance changes in that market. Now, the hope and pray might not be a good strategy. Maybe you need a third indicator that tells you there's something coming in terms of corporate governance changes. But effectively, it's a probability that you're changing of management changing. That's the way I think about corporate governance, is corporate governance is all about this probability of control changing. Corporate governance doesn't change value. Corporate governance is the probability of control changing. You still have the status quo and the optimal value driving the value of every company. So when you think about the value of a publicly traded company, here's the way to think about the value. You have a status quo value plus a probability of control change built into the price times the difference between the optimal value and the status quo value. Divide by the number of shares outstanding, you have the value per share. Now let's think about voting and non-voting shares in this world. Let's say you guys buy voting shares in a company and you guys have non-voting shares in the company. The way I think about non-voting shares is you are stuck with the status quo value. There's nothing you can do. So if you ask me what's my value per share and you have non-voting shares, here's what I'm going to do. I'm going to take the status quo value, divide by the total number of shares outstanding, and that's going to become the value of the non-voting shares. You know what you get as voting shareholders? You get a chance to change the way the company's run. I'm going to take the entire expected value of control and I'm going to divide just by the voting shares in the company, and I'm going to give you that premium. Now do you see why I said the premium that you see for voting versus non-voting shares is going to be entirely a function of the expected value of control? If that number is zero, either because the company is perfectly run or because there's no chance you can change the management, then the voting shares are going to converge on the non-voting shares. I'll take a final example and we'll end with this. Brazil, about 80% of the companies that are publicly traded have two classes of shares. They're called common and preferred, but they're really voting shares and non-voting shares. So this is actually Embraer, one of my favorite Brazilian companies. You've taken a short haul flight in the US, you probably sat in an Embraer jet. And I did two valuations of the company. A status quo value that gave me 12.5 billion reais, and an optimal value which gave me 14.7 billion reais. I changed the debt ratio, reinvestment rate. It's very similar to what I did for SAP and Blockbuster. So I have two different values. The company has 242.5 million voting shares and 477 million non-voting shares. So here's what I'm going to try to do. I'm going to try to first estimate the value per non-voting share. To do that, I took the 12.5 billion, divided by the total number of shares outstanding, saying if you're a non-voting shareholder, that's going to be a value per share. The value that I got was 17.38 reais per share. Then I took that 17.38 and to that I added an expected value. And here I might be optimistic in attaching a 20% chance that management will change. But Embraer, that would have been a zero if it were Petrobras or Vale. But because Embraer, there's still some chance. I put a 20% chance. 20% chance of 2.2 billion, which is the difference in value, divided by just the voting shares, gives me a value of $19.19. I would expect the voting shares to trade at a premium of roughly 10% over the non-voting shares. And it will, because I think there's an expected value of control and the voting shareholders captured. What I'd like you to think about is what will cause that premium to go to zero. And you can already see what you'd have to play with. And what will cause that premium to expand. And I'll close with something that comes out of the Brazilian market. For the longest time, Brazilian markets, until about probably 2003 or 2004, the non-voting shares used to trade at a premium over the voting shares. The premium came from the fact that they were more liquid. So basically, people ignored the fact that non-voting shares had voting rights, had no voting rights. They said, who cares? You know what changed that? When Embraer was acquired in a hostile acquisition by a Belgian brewer, and in the hostile acquisition, the acquirer paid a premium only to the voting shareholders. I was actually a non-voting shareholder in Embraer when it happened. I remember how pissed off I was. Because they were getting 100% premium and I was getting nothing. And there was nothing I could do about it. But you know what happened after the Embraer acquisition? You started to see voting shares trade at a premium over non-voting shares because people got a reminder of why control matters. And sometimes you need an event like that to wake up the market. But that's a way to think about that premium. And final example, and we'll end with this. If you gave me a private company to value, and you said, what's 51% of value? I'm going to take the optimal value and give you 51% because you're going to be running the company. But if you gave me 49%, I'm going to take 49% of the status quo value because I don't control how the company is run. Which can cause this huge difference in what you're willing to pay. And it's only a 2% difference, but that's a way to think about the minority discount. So I'll send you a link to, I have a paper on the value of control. It's actually a chapter from one of my books, but it essentially looks at how control plays out in so many different things that we do in valuation. But please send in your numbers for your project as soon as you have them. I'll send that summary sheet again. Basically it requires, what's your DCF value, what's your price. It asks you what you'd concluded by Sunday, and then I'll kind of pull the numbers together, and on Monday we'll see what you found. So I'll see you on Monday, last day of class.